Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Welcome, everyone. You join us again as we record in the icy confines of central London in the FT offices. It's been another week of closely watched company results, the big one being figures from Nvidia overnight as we record, which once again more or less met lofty expectations. And this week does see the publication of our annual US special edition, in which we seek out the very highest quality companies, including those, unlike Nvidia, you may not have heard of. Today on the show, Mike Fairhey is discussing one of these, a company that doesn't sound very glamorous, but is in fact bigger than all but 5 businesses in the FTSE 100. That's Illinois Toolworks. We'll be talking about its attributes very shortly. Closer to home, we are also going to be discussing UK mid-cap build-to-rent business Grainger, which is on the other side of the elevated rental growth that's been a big problem for a lot of the population in recent times. Natasha Vose is here to talk further about that. We are going to begin, though, with Julian Hoffman in the hot seat, looking at one of the big gainers of the week, accounting software business Sage. It reported full-year figures on Wednesday and has pretty much silenced the doubters after a couple of indifferent quarters. Julian, what did we glean from the result?
Well, hi, Dan. Yes, it was the biggest riser of the week, something like 18%. I think the shares went up on the day. It was quite a stark result for such a large company. There are a couple of things that were quite noticeable about Sage in these results. One is it seemed to take the management themselves by surprise. Everyone at the half year had noted what had looked like a moderating environment for Sage, and they had actually downgraded albeit modestly, their full year expectations, which is why we actually downgraded the company from buy to a hold. We can't blame Jennifer now because she's not of this parish anymore. But the upshot of that was that the second half of the fourth quarter was where there was a sudden upsurge in growth for Sage, and that seems to be coming out of North America primarily. So the US business is growing by about 12% a year at the moment. Sage has very high levels of annual recurring revenue, something like 90% of its revenue, 97% of its revenue is now on a recurring basis. So as soon as it gets new signups or existing customers upgrade the service that they have, that flows very, very quickly to the bottom line for Sage, and they generate a lot of operational gearing on that basis. So it was a very surprising set of results, I think, all round. Certainly the market was taken by surprise. But Sage itself is quite, it's a very responsive company to how companies are using budgets. So what you can glean from the results really is that people were pushing through spending on their software in anticipation that their underlying businesses are going to grow. So it's quite a useful lead indicator, I think, for next year's performance for a lot of companies in other sectors.
Yeah, it does seem like it may be that way. Well, let's hope it's that way, given things are positive, certainly in the SME segment. We can talk about maybe geographic spread in a minute. What about next year then? What are they guiding on that basis, on the basis of these figures for 2025?
So that gets a little murkier. I think they should, at least their own view is that they will at least match the performance that they've seen. What they don't seem to be prepared to commit to is how much in advance of, based on half a quarter of one quarter's performance, that is going to be. So they're hinting at going up about 200 basis points of margin. So that implies a certain amount of margin expansion for 2025. But that is coming out of this fourth quarter performance. Prior to that, it was under 200 basis points. So there is a small upgrade, but it's not massive in terms of Sage's overall performance. And where it may fall down a bit is that while America is doing very well in terms of its growth, the Europe part of the business is relatively underdeveloped by comparison. So they have a product they called Intact, which is marketed throughout Europe. As we all know, the German economy is not doing very well. The French economy is also sickly. So their core markets there are not experiencing the same level of growth as in North America, and that lagging growth might continue into next year. So that's an unknown for them. Their counter argument, obviously, is that Europe, because the rollout in Europe is much smaller than the US, that there is a much bigger market opportunity. But ideally, you would want to see both of those geographies pushing through the same growth in order for their expectations next year to be materially ahead of where they are at the moment. There's very little visibility really on how they can forward project their earnings. I mean, even the fact that they were taken by surprise in this last quarter is indicative that is a problem. Forecasting is a problem.
Yeah, the revenue growth I think they're predicting next year is slightly below the fourth quarter levels, but then they do tend to end the year strongly. And as you say, you can't really extrapolate from one quarter. The positives did, which have entirely erased the drop we saw earlier in the year without warning, seem to stem from, as you alluded to earlier, the annual recurring revenue growth, which after trailing away for a couple of quarters or so has jumped up again, even by the standards of the fourth quarter. So that looks fairly solid there. Clearly, for this kind of business, it's making sure that recurring revenue is coming through is crucial, and continuing to see the growth there as well is crucial.
That was up 11%, which was quite, as you said, quite a notable increase, but all predicated on that half of one quarter. The market definitely is rewarding them for their kind of persistence, I suppose. And they have put a lot of effort into improving the offering. And in the old days, you used to get 7 or 8 compact discs with Sage on it, and you'd have to load it onto a desktop. And now it's a much more simple and easy to use product. And it's a rare case really of a company where technology has moved to actually improve its business model rather than destroy it. It's been around almost as long as I have. So they started in 1981. So it's quite a mature company from that point of view. But it seems to be getting this earnings boost from the quality of its business model is improving with time rather than facing extinction. I mean, as another company might. But it doesn't mean that it doesn't have competitors.
Yeah, on that subject, I mean, on the technology point, the technology that everyone thinks about nowadays is, of course, AI, and they have an AI digital assistant, which they say is making good progress, which is the kind of perhaps vague talk you might expect at this stage. But nonetheless, they do, as you say, seem to have been boosting their service, which is important because another worry the market has had is whether peers are trying to eat their lunch or whether they're effectively going to do that. There are quite a lot of high-profile companies operating in a similar kind of space, Intuit, with QuickBooks being one of them. And those companies are still growing. QuickBooks is bigger than Sage's business in that area, but it is still growing at a quicker rate too. So even though this quarter, this half, very positive, there may still be some headwinds to watch there if that kind of competition, particularly in the big North American market, which everyone wants a piece of, starts to grow.
Well, it's interesting. I mean, the QuickBooks, everyone sort of knows about QuickBooks because it was involved. It sort of turned up in that Sam Bankman-Fried fraud in America with that crypto exchange that went bust. They were, that very large company was using QuickBooks as its accounting software. The counter argument, I guess, to that is that Sage's specialization tends to be in small and medium-sized players or small and medium-sized companies. It's not an area that particularly interests some of its larger rivals who tend to focus on the bigger corporate market. They're always going to face competition. I think that's and that is, in a sense, is what spurs the company to keep going. Their argument as well is that although North America is an important market, it is Europe where they think they'll grow fastest. If European companies start to adopt, this kind of digital rollout for their accounting software in a more sort of timely and quicker way, you can read what you want out of that. I think to give them a due, they're a very efficient business. Costs are remaining flat, and on that kind of cost base, they're generating a lot of operational gearing. You can't really fault them for their operations. I think that's the best way of putting it. I mean, I put the shares back to buy.
I was about to ask on the valuation argument.
Well, because they are actually quite undervalued in many ways. So the forward valuation is something like 25. Went down to 25. Is up to closer to 30, but the peer group is more like 33 to 35 PE. So it's a definite discount. That might be, of course, the implication of the FTSE discount on it. But just from a sort of an absolute value, they're not actually expensive even at their current levels. And if they can sustain these end of year surprises, then they should make it up at least to the value of the sector as a whole. Or at least to their peer group as a whole. So there's a definite relative value argument there.
Yeah, as you say, if they keep executing in this way, and there's maybe a hint that the guidance is a bit conservative as well, which gives them room to outperform next year. We will see. Let's turn to the US itself now, though. As I say, this week does see the publication of our Quality Shares US special, based on a US version of our Quality Stock Screen, looking at companies which, well, some of the attributes we'll get to in a minute, but effectively Each year we run the screen, look at some businesses in the US, some different businesses, some unusual names are often in there, as is the case here. Mike, you are, well, one of the many times you've been on the show was this time last year when we were talking about Fastenal, which is another similar kind of industrial business to the company we're about to talk about, Illinois Toolworks. That company had a very good 12 months, so who knows, maybe Illinois will be the winner of the year ahead, albeit I know you're a bit cautious on them. The beauty, if you will, taking the optimistic view of the quality screen, is that these are long-term compounders. That does mean, though, that sometimes the near-term outlook can be a bit more cloudy. But let's talk about what they do to begin with. I imagine a lot of listeners won't have heard of them. You can infer a little bit from the name, but what do they do? How did they come about? Because that's also an interesting story as well.
Like you said, it is similar to Fastenal in one way, in that they're both, you could describe both of them really as nuts and bolts type companies. The difference being that Fastenal is kind of more of a distributor and an inventory management company. The thousands of little parts it will sell to companies and handle how much are in the stores, whereas ITW, Illinois Toolworks, is more of a manufacturer. As you said, it's got quite a storied history. It's over 100 years old and an interesting start. It was actually founded by a financier in Chicago called Byron Smith, who placed an advert in The Economist for companies or for investment ideas around manufacturing, and he ended up backing a group of tool makers who came together to found this company, and it's obviously grown quite substantially since. It's now 16 billion in sales last year and about 45,000 people worldwide.
Yeah, I mean, I don't know if that's something that still happens. I don't think it does. People appealing for investment opportunities in The Economist, but it's clearly worked out quite well. Let's talk about what makes it a quality business, because that should shed some light on the screen itself, the kind
Sure.
of things our screen looks for.
So, a little word first on, I don't think I've properly explained what it does. It's in a massive variety of sectors. Its biggest is automotive. One of its earliest acquisitions back in the 1920s was for a company that made washers that solved particular problems that the car makers at the time had. And it's diversified a lot since. Quite a bit of that was through acquisitions. In the 80s, it did 30 odd acquisitions, which doubled it in size. But end markets are everything from automotive to construction, where it is literally nuts and bolts plus nail guns and other things. There's quite a lot of in food equipment, in the fridges and ovens, etc., in industrial kitchens, and a lot in electrical testing equipment. But yeah, in terms of what metrics led to it featuring on our quality screen, it's very big on strategy and processes. It talks a lot about customer-facing execution and driving R&D efforts from the customer backwards. So spending its research money on solving customers' problems rather than having a central research unit that's coming up with ideas that maybe aren't all that important. And 10 years ago, it set this enterprise strategy aimed at delivering what it described as best-in-class margins and returns, which is an easy thing to say, but obviously it's much harder to do. And over that time, it has done very well. Its operating margin is up by more than 9 percentage points over the decade to 25%. It's very good on returns on capital as well. Back in 2013, that was 12%. It's up to 31% over the last year. And that's fed through into much higher earnings and dividends. Its dividends have tripled over the past decade. And in fact, they were up for the last 60 years in a row.
Yeah, as you say, these are some of the metrics that we look for, some of the reasons this surfaced on the screen to begin with. A very profitable business, high margin, high returns, a decent outlook as well in terms of forecast, but you're a bit more circumspect about the near-term prospects.
I suppose when you're looking at the end markets, and two of the bigger ones are automotive and construction, sales in the automotive industry, they've been pretty flat this year, although S&P is suggesting there might be a pickup in volumes. Prices are still under pressure. And similarly, construction, there's been this relative boom in new housing in the US, mainly because when mortgage rates went up and everybody's on 30-year deals, nobody moves out. When you've got markets like that softening, you can see that in its third quarter results, where its sales were about 4 billion, which were slightly below analyst expectations, although it kept its full year guidance for both sales and margins unchanged. And then when you start to look at analyst forecasts, analysts are still forecasting quite decent margin growth this year, and for earnings per share to grow by about 17%. But a lot of that has come through on flat sales. It's come through the improvements in processes, etc. And one of the analysts at Morningstar that we were looking at suggesting that might be a harder trick to pull off next year.
That feeds into the next point about the valuation, which is often the downside with these quality shares. You do have to pay up for that quality, which make things a bit tricky in the near term, given what you've just described.
I mean, it still has some very ambitious targets. It's set a new phase of its strategy this year, of which it's looking to do much more of the same in terms of margin improvement and in terms of returns on capital. But as the 9 percentage point margin improvement it's had over the past decade to 25%, once you're at that level, making further improvements becomes slightly more difficult. So it's talking about between now and 2030 an increase in operating margin to 30%, but its focus is much more on organic growth for the near future, which at 4% a year, plus some buybacks and some judicious acquisitions along the way. It's kind of targeting total shareholder returns of about 10 to 11%. But I think the hardest part of that will be the continued margin improvement.
Yeah. When I was writing the intro to this section, it did remind me a bit of, given we hear Warren Buffett right now putting a lot in cash, it's the old Buffett versus Munger argument almost. As a erstwhile colleague, Charlie Munger, said to him in the 60s, a great business at a fair price is superior to a fair business at a great price. But the question of fair and great and the definition is always the difficult thing to answer there. But as I say, that is our cover feature this week, online, in print. 3 other companies in there, including quite an interesting semiconductor/AI play that I wrote about, but I'll leave you to look at that online or in print if you're listening right now and you're interested in these US businesses. You can now get 12 weeks of an Investors Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to return to the UK for our final segment, looking at Grainger, the build-to-rent landlord that is on its way to becoming a REIT, which it will do next year, all being well. It's very much keyed in, Natasha, to the rental market, as I said at the top, which, as a lot of people will know, is booming is maybe the wrong word, given what we're talking about here, but rental growth has been very strong, and these results also seem pretty strong on the back of that.
All in all, it's pretty good showing. I mean, it's been quite a sort of downbeat week for commercial property reporting, but Grainger has increased net rental income by 14% this year. Their PRS rental growth is up 6.3% on a like-for-like basis. And this also contributed to the 14% increase in dividend, which is now at 7.55p per share. So, yeah, it's a pretty good performance. And then it further graded its EPRA earnings guidance for 2026 by 5 million, and then expects its EBITDA margin to increase from 54% to over 60% by 2029. As you said, rental market's booming. I mean, as a renter, this sometimes makes me a little bit sad, but it's good for Grainger shareholders. And yeah, it's doing well. I mean, there is sort of one area to touch on, which is what happens when the rental growth starts to slow a little bit, which is expected to happen, though. Sadly, supply-demand dynamics means that it's not going to be easy for renters, even if there is a slight slow in rental growth. I spoke to the CEO this morning, and she said that the model is designed to support rental growth of about 3 to 3.5%. So even if rental growth halves, Grainger will still be in a pretty good place.
They seem to be saying, don't they, that's the structural growth that has been in the past, but they see it leveling out at a slightly higher level, maybe 4 or 5, which should support them, therefore. The thing that struck me when you consider this, because a lot of people have been discussing rental growth this year, and again, that's their main focus, is why haven't the shares done better over the year? Clearly, there's been political uncertainty, there's interest rate expectations involved in there as well, but the shares have struggled a bit this year. Do we have any insights as to why that might be?
Yeah, as you say, it's a little bit odd because the share price is down, I think about 13% when I checked this morning, over the year to date, which seems odd given the performance of Grainger at both its half year and now its full year results. And so I think that what's going on here is that you've got a lot of investors who invest in property on a macro basis, and they group Grainger either in with the house builders because of its development pipeline or in with the sort of commercial property market. And both of those are really interest rate sensitive. And so every time interest rate expectations change, so whether that was after the recent budget, we see that property stocks go down and are often the biggest fallers of the day. So I think that it's really a reflection of the wider market and wider sentiment about property rather than actually reflecting the company itself.
Yeah, that does seem fair. In May, there was a bit of a hit when there was the withdrawal of multiple dwellings relief, which hit NTA a little bit. So that seems to be a specific hit. But other than that, as you say, a lot of it is the macro.
And in terms of sort of political reform, I mean, Grainger actually welcomes the Renters Reform Act because they say that they already kind of maintain high standards. So for them, it's not really a problem, which is just something to sort of bear in mind when that starts going through.
Yeah, of course, they would like to strike a positive tone, but it does seem like the market agrees with them on that front. What about the outlook, given all these dynamics then? What are they saying about the next few years? We've touched on rental growth, but they do also have this pipeline you spoke about. What are their plans in terms of building? Because there is this demand-supply imbalance. They are building a certain amount as well. What are their plans there?
So I was talking about this a little bit this morning, particularly because some of the house builders have highlighted cost inflation in their recent results. And as you say, the pipeline is big. I mean, it's 1.4 billion, and that's about 4,730 new homes. I think if we sort of look at the market, that's not going to fix the entire supply problem in the BTR market. So it's not, even if you were to have all of those come online at the same moment, I mean, the context of, say, the London population, 4,730 new homes, even if you've got 2 people per home, isn't huge. But then I think what's kind of interesting about it is that unlike the house builders, where that might be more exposed to cost inflation, the costs are actually fixed, according to Deutsche Numis's note this morning, which means that they shouldn't be as hit by material cost inflation. Although the CEO did say that they do see sort of the same issues with labour shortages as the house builders, which is quite interesting.
Yeah, that is certainly something to watch. As you say, there are a number of factors at play there. Cost inflation is coming through elsewhere. Build to rent, we shouldn't forget, is a relatively new sector in itself, born out of the shortage of supply. So these building targets are never going to address an issue that was entirely someone else's problem, if you want to put it that way, until a few years ago. But it's clear they see an opportunity there. We can also talk maybe about the changing demographic of some of their renters, because there was an FT piece a few months ago now, again, slightly depressing, but talking about people renting in middle age, even old age, and therefore, for someone like Grainger, these people who may not want to be renting, but they don't have much other choice, are more attractive as a kind of tenant because they don't tend to move and they tend to want to, put down roots. And Grainger has been trying to attract more of these people, though I imagine it might still be it probably is a pretty small part of their customer base overall.
As you say, it's still relatively small. I mean, it depends on how you define middle age, I suppose.
Well, yeah. I don't want to go into that, personally speaking, but go on.
84% of their customers are between 20 and 40. And they give a chart which doesn't give the sort of precise numbers, but it does give an idea of kind of magnitude for each group. And their biggest single demographic is between 25 and 29 years old, which does make sense. And then there's a pretty even split between 20 to 24, who I'm guessing are probably students. But they do also have some more middle-aged renters, which I'm defining sympathetically as over 55.
Yeah, I'm happy with that.
Yeah. And it is, like you say, it's a pretty small block in the bar chart. But then, as I guess it's become more and more difficult to get on the property ladder, people are renting for longer. And the BTR community would tell you that there's nothing wrong with that. And many other countries have sort of a culture of renting. I mean, personally, I find that slightly depressing and I'm thoroughly wedded to the idea of buying a home. But I suppose it's another point of view. I mean, a cynic could also say that, of course, the BTR community thinks it's great that people will rent for longer.
Indeed. It is true that in other countries they do more renting, and things like the Renters Reform Act are in some ways attempts to level the playing field, aren't they? Because the flip side of what we always say about other countries is that they do have stronger protections for renters, so it's more attractive to do so. So maybe that's something that will come out as well. As you say, a small thing for now, but something to watch as the years go by, I suppose. We have now, though, run out of time, unfortunately, for today. The time has gone by for us very quickly, but thank you very much to Mike. Thank you to Julian. Thank you to Natasha for joining us on your birthday. Happy birthday, Natasha.
Not middle-aged.
No, nowhere near middle-aged, we should clarify. And thank you to Maddie Apthorpe, our producer. We'll be back next week with another Companies and Markets show.